You're welcome back to Business Morning. German Finance Minister Wolfgang Schäuble says the EU members need to do everything to stabilize the bloc in the wake of Brexit. This is part of the comments coming as the various member countries are meeting to see how the exit of the UK from the EU will not affect the development in the bloc.
German Finance Minister Wolfgang Schäuble on Saturday said the European Union countries had to ensure that Britain's vote to leave does not lead to a further weakening of the bloc.
Wir haben viele Stunden gestern alle 28 intensiv diskutiert.
It is evident that we need to do everything to stabilize the European Union.
In June, Schäuble's ministry drafted a reform plan for stricter budget rules for EU states and a downsized European Commission as a result of the Brexit vote. He added on Saturday that a stalled EU tax plan on financial transactions was a genuinely good idea which can only be realized if it's done globally. France and Germany had led efforts to create the tax on an EU level, which was supposed to help recover public funds used to bail out banks in the financial crisis and to curb speculative trading. However, the talks have dragged on since 2011 as countries struggle to agree what instruments should be covered and at what rate. In January 2016, the number of countries backing it was 10 out of the then 28 European states. Schäuble said he raised the prospect of a global financial transactions tax at a meeting of the group of 20 major economies in China's southwestern city of Chengdu in July. Asked whether discussions meant the tax had failed on a European level for the time being, Schäuble said, no, on the contrary. The European level has resulted in our progress on a global level.
Still on the EU, where the Commission's Vice President says the new rules on tax systems are needed to avoid exploitation by multinational companies whose abuses increase public frustration.
EU Commission Vice President Jyrki Katainen said over the weekend that new rules were needed to eliminate mismatches and loopholes between member state tax systems that companies exploit and which increase public frustration.
What's clear is that with every new case of unfair tax practice or abuse, public frustration grows. Governments will need to look closely at the current tax systems and assess whether they are fit for purpose and meet public expectations of greater fairness.
The Commission, which is in charge of protecting market competition in Europe, is investigating multinationals' tax arrangements in several EU countries to assess whether, by lowering corporations' tax bills, illegal state aid may have been given.
In order to make sure to avoid
Ministers at the meeting also discussed a paper presented by the Slovak presidency of the EU calling for more tax certainty for multinationals. It aims to step up cooperation among EU states and also make companies' tax bills more predictable. Online retailer Amazon.com and hamburger group McDonald's face European Commission probes over taxes in Luxembourg, while coffee chain Starbucks has been ordered to pay up to 30 million euros in back taxes to the Dutch state.
Have a nice weekend here.
The Netherlands has appealed against the Commission's decision, and Ireland did the same in the Apple case, fearing it could undermine the country's long-established policy of attracting multinationals with low taxes.
And back home, the Debt Management Office will be offering 120 billion naira worth of bonds this week, as analysts expect the market to take a cue from last week's auction results as well as the release of August inflation figures. Meantime, trading started bullish and then remained bearish for most of the week. Yields climbed further by 12 basis points to close at 16.3%, and rates expanded across the curve with the short, intermediate and long ends expanding by 22 basis points, 8 and 2 basis points each. Now let's take a look at the fixed income market in broader detail, as a number of auctions are expected at the financial markets in the last quarter of the year. Pabina Yinkiri is the head of research at Vetiva Capital Management. joins me on the program. It's good to have you on the show, Pabina.
Thanks for having me.
Now, the financial markets are expected to open in a vibrant fashion this week when trading activities reopen after the Muslim holiday. Now, the Debt Management Office is expected to kickstart activities at the debt market. What is your view on the different forms of auctions?
If you look at the auctions primarily, for the T-bill section, it's basically to refinance maturing bills. And then for the bond auction, it's in line with the bond calendar that has been set out for the period. What you will notice across both auctions is that there is an increase in the sum that is expected to be sold to the markets. So an indication of the fact that the government continues to underperform its revenue assumptions, and the budget deficit is ever getting wider. If you recall, as at half year, we're already 83% of the full year budget deficit. So what it goes to show is that the government may have to overshoot its borrowing limits for the year.
Now, while the Debt Management Office will begin its own auction, the central bank, like you rightly mentioned, also plans to sell treasury bills. What level of impact are we expected to see as a result of these auctions in the markets?
Yes, we'll continue to see treasury bill yields at very, very high levels. The increase in supply would mean that yields would have to be a little higher for markets to clear out. So you'll likely see an adjustment of the yield curve at the short end, further going up. And I expect that when the bonds are issued as well, you would see a little upward shift in that space as well. All of this also coincides with the fact that we are currently in a tight monetary policy environment, and yields are expected to stay relatively high, at least up until the end of the year.
Now, analysts say that the planned issuance of T-bills would help plug federal government's proposed 2016 budget deficit of over 2 trillion naira. Now, how far can these funds help, going by the need to inject a lot of funds in the economy to aid growth?
Okay, the budget deficit, planned budget deficit of 2.2 is expected to be financed by 1.8 trillion naira of borrowings. Just about half of that should be domestic borrowing, whilst the rest will be international borrowing. If you recall, the Minister of Finance had indicated that the government is making plans to tap into the international markets in the coming quarter. And for domestic borrowing, which I mentioned earlier, it appears the government may have to overshoot its target. The government had planned to borrow about 985 billion based on the budget, but I clearly think we are going to overshoot that. If you look at the budget deficit as at half year, deficit was around 1.8 trillion compared to a half year target of 1.1. So if you analyze that figure, we could probably be looking at a budget deficit of about 3.6 trillion naira, which is significantly above the 2.2 trillion that the government had set. All of this is coming because of the fact that revenues continue to underperform because of the issues happening in the Niger Delta and the slower inflow of oil receipts. So those are the things playing out.
All right, thank you so much, Pabina Yunkeri, Head of Research at Vetiva Capital Management. Okay, we'll go on a break, and when we come back, we'll be talking to you about plans by GlaxoSmithKline to sell its portfolio of anesthetic drugs to South Africa's Aspen Pharmacare for up to $372 million.